Today saw both bonds and stocks battered. The 10-year treasuries are having their worst start to a year in at least 30 years, and stocks are having their worst start to a year since 2016 and the third worst in at least 30 years. Treasury yield spiked with the 10-year yield near 1.9% for its highest level since January of 2020. Commodity prices also gained during the day with the U.S. WTI crude oil futures hitting near $85 per barrel, which is the highest settlement since October of 2014. The volatility across risk assets largely reflects investors' ongoing concern with highly valued asset prices, the possibility of interest rate hikes, and the looming reduction of liquidity out of the Federal Reserve. Fed officials are currently in a blackout period before their meeting next week. However, it's clear they are preparing to raise interest rates and eventually draw down nearly $9 trillion from the Fed's balance sheet. And as we move toward the first rate hike expected in March, the volatility may present buying opportunities in stocks that have very steady growth, increasing cash flows, and attractive prices. But at this time, I still don't have any to present to you. I'll keep looking. Until then, let's look at two charts. In our first chart here is the 6-month daily volatility index, and the symbol is $VIX using stockcharts.com. Now, as you can see, we were relatively low here in the 15-point level at this stage, late October, early November, but then we did that climb all the way up here to above 34 in early December. Now, we did calm down, had a little bit of another eruption to this point here under 28, and then down further we went, but we're moving on the way up again. You can see here in the lower portion, the MACD, we bottomed and based with the fast line moving over the slow line, and both the slow line in the red and the fast line in the black are heading on up to that zero line, and there's some separation with looks like continued momentum here as well as in this price chart. You can see we're moving on up. We're at 22.79, but that separation seems to be growing, so we might accelerate up here a little bit further. Are we going to go all the way up to 34? Not likely, but we could hit that 26 to 28 level once again. Just have to keep your eye on it. Here in the upper portion is the RSI. Nice basing period here, and you can see we moved on up to that midline or 50 level. We're above that at 58.6, and we're going to continue on higher, perhaps up to that 70 level, as we did back here again in late November. We hit that level back here too in September, and then nothing else. But we did have a few bumps in the road on the way. So I would imagine that we're not going to go too much higher, but that is creating some tumultuation in the stocks. So let's go ahead and take a look at our charts. And this chart here is the 6-month daily on the spiders, the SPY, and the close on Tuesday was 456.49. Now going back here to the October time frame, from this point on all the way up through here, we still have a relatively decent trend line. We did break through that, but my lines never really mean all that much. I'm not too worried about that. It's possible that we're going to come on down here to this 450. If so, then we'll probably have a triple bottom there, and then here. But it's possible we can go a little bit further than that. Regardless, I'm not too concerned. I don't see a lot more momentum on the downside, and we'll take a look at that through the oscillators. Here in the volume, we had a declining volume for the most part up until the last couple of days. We had that peak there in December, here mid-December, and then more recently at this level here, but we did pick up again, and that's a bit of a problem, but not a real concern. Here into the MAC, you can see the separation between the fast line there and the slow line here, and it's accelerating on the downside, and we are now below that zero line, which means things are getting weaker. I would imagine we're going to perhaps come down here a little bit further, maybe as far as we did say in early October, but I'm not really sure about that yet. I think the probability is that we will turn before then, but we'll see. Here in the histogram, you can see that we attempted a bottom and basing there. It was a very limited attempt, was not successful. Here too was another, say, minor attempt, but we breached that with today's trading. So hopefully we'll bottom and base someplace around this -2 line as we did here in December and say there in September, October time frame. I don't think things are going to get much worse than that. Here in the price rate of change, this fast line definitely wants to head on down, but I think that's going to be overdone here pretty soon. We're almost at -25. We didn't get down there in December nor in this September October time frame, so I think this is an overshoot, but we still have some sawtoothing to do before the slow line catches up and we can bottom and base. Moving on into the RSI, that too looks to be relatively normal for a pullback. I don't see much more than a pullback. We're almost on our way to that 20 level. We did not reach it in December, and we did not reach it there in that September time frame. So I think this is probably going to be about the same as in these two previous cases. Moving into the stochastic, that definitely shows that we have more downside here, certainly with the fast line and the slow line, but once again I think we'll stop before that 20 level as we did in December and September, October. One last look here into the Williams, pretty much the same thing. Again, none of these oscillators are indicating anything more severe than a typical pullback, but there is some volatility out there, and during that volatility you can do a number of things. First, I'd like you to start stacking more cash for those opportunities that I think will come up between now and March, and perhaps even after March if there is a rate hike, and I think the expectations are pretty high for that. So always have some extra cash just in case some opportunities pop up. But for now, I think we're still on the downside. We're at the 456. I think we get down here to this 450 level, and we'll see if we can do a triple bottom. Hopefully we'll do some bottoming and basing soon thereafter and then start heading up. But I think that's going to be later this week and likely into next week. And so for today, that's ChewDog Charts. Thank you.